Hello everyone. Today we'll be looking over the financial analysis of FedEx. FedEx current ratios from 2021 to 2024 are higher than the industry average of 1.23 in 2024. This shows stronger short-term liquidity. Some of these implications mean better liquidity, so FedEx can easily cover short-term obligations compared to its industry peers, a lower financial risk, which means a less risk of financial distress due to strong cash and asset reserves. Potential excess liquidity could indicate inefficient use of resources or missed growth opportunities. And investor confidence, strong liquidity reassures investors and creditors. The conclusion is that FedEx is well positioned for short-term stability but may need to optimize its capital use. FedEx's cash ratio in the past 4 years is slightly below the industry average of 0.52 in 2024. This indicates less reliance on cash reserves to cover the liabilities. Some of these implications include sufficient liquidity, so FedEx has adequate cash, but less than the industry average to cover short-term liabilities purely with the cash on hand, has lower risk but efficient use of cash. While slightly lower, this could mean FedEx is using cash efficiently for operations and investments. Balance of cash and other assets. FedEx's liquidity comes from more than receivables and other assets than just cash, balancing its flexibility and risk. So in conclusion, FedEx is highly liquid, which minimizes the risk, but they also may benefit from optimizing its liquid asset use. FedEx's cash ratios are consistently close to, but slightly below the industry average in 2024. This indicates a balanced approach to liquidity management. Some of these implications include sufficient liquidity, so FedEx maintains a solid cash position, efficiently managing its liquidity while remaining competitive within the transportation industry. Its efficient use of cash means a slightly lower cash ratio suggests that FedEx effectively allocates its cash into operations and investments rather than holding large amounts in reserve. This also goes into risk management, so while slightly below the industry, FedEx's cash position is still strong, reflecting its careful liquidity management without compromising its operational flexibility. So in conclusion, FedEx maintains a solid cash position. It efficiently manages its liquidity while also remaining competitive within the transportation industry. FedEx's asset turnover ratio is higher than the industry average of 1.03 in 2024. This indicates its efficient use of assets to generate revenue. Some of these implications include efficient asset use, so FedEx generates more revenue per dollar of assets compared to the industry, which reflects its effective asset management. Operational efficiency. Higher asset turnover suggests that FedEx maximizes its asset base to drive sales. Revenue generation focus. FedEx operations are well structured to convert assets into sales quickly and efficiently. In conclusion, FedEx excels in asset utilization, which drives its revenue growth and its operational efficiency, making it competitive within the transportation sector. FedEx's inventory turnover ratio for 2021 to 2024 is significantly higher than the industry average of 38.22. This indicates faster inventory movement. So some of these implications include efficient inventory management. So FedEx moves its inventory more quickly than the industry average, which reduces storage costs and improves the cash flow. Minimized holding costs include a higher ratio, suggesting that FedEx is better at minimizing excess inventory and avoiding overstocking. Stronger operational efficiency also means that FedEx has rapid inventory turnover, which reflects its effective supply chain and inventory management, reducing risk of obsolescence. To conclude, FedEx efficiently manages its inventory, which translates it into a better cash flow and reduced costs, giving it that competitive edge in inventory handling. FedEx's days sales in inventory is lower than the industry average of 9.55 days in 2024. This indicates a faster inventory turnover. These implications include faster inventory turnover, as mentioned above, so a lower DSI means FedEx takes fewer days to sell its inventory, leading to quicker revenue generation and better cash flow. Reduced holding costs, which means shorter inventory holding periods minimize storage costs and reduce the risk of inventory obsolescence, as mentioned in the previous slide. Operational efficiency, kind of going back to that point, a low DSI reflects FedEx's ability to manage its supply chain efficiently, ensuring optimal inventory levels to meet demand without overstocking. So in conclusion, FedEx excels in its inventory management. By selling its inventory more quickly than the industry average, it improves its cash flow and operational efficiency. FedEx's days sales outstanding is very similar to the industry average of 41.35 days in 2024. This indicates average efficiency in collecting its receivables. These implications include moderate receivables collection. So FedEx takes about 41 days to collect payments from customers, aligning with the industry norm. Balanced credit management. This DSO shows that FedEx manages customer credit terms effectively, avoiding delays in receivables. Cash flow stability. By collecting payments within a reasonable time frame, FedEx maintains a steady cash flow, reducing its reliance on external financing. So in conclusion, FedEx's DSO reflects its effective receivables management, which keeps the cash flow consistent while maintaining competitive terms with customers and other firms in the industry. FedEx's debt-to-assets ratio is lower than the industry average of 0.41 in 24, which indicates it has a more conservative approach to debt management. So like I mentioned, its implications, lower debt exposure. Since it has consistently lower debt relative to its total assets compared to the industry, this indicates a more conservative use of leverage. Financial stability, lower debt to assets suggests FedEx is less reliant on borrowing, which reduces the financial risk in uncertain economic conditions. Greater flexibility also means that with lower debt levels, FedEx has more financial flexibility for investments and growth opportunities. So in conclusion, FedEx's conservative debt management strategy reduces the chance of financial risk, which positions the company well for stability and future growth. FedEx's debt-to-equity ratios reflect its approach to leveraging its equity to finance its operations more effectively. The industry average comparison is essential for understanding how FedEx balances its debt with its shareholder equity. These implications include lower debt exposure, as mentioned in the previous slide. So a stable debt-to-equity ratio shows that FedEx is effectively managing debt while maintaining strong shareholder equity. Financial health. So a reasonable ratio suggests that FedEx is not over-leveraging itself and has a good balance between debt and equity. Investor confidence. Lower debt relative to equity can instill more confidence in investors, which shows the company is not overly dependent on borrowing to fund operations. So in conclusion, FedEx maintains, a solid balance of debt and equity while also ensuring its financial stability. This helps it control its leverage and offers a favorable outlook for both creditors and shareholders. FedEx's gross margin ratios demonstrate its efficiency in generating profit from its core operations before accounting for operating expenses with comparisons to industry benchmarks. The implications include strong operational profitability. So FedEx's gross margin reflects its ability to manage costs and pricing, ensuring that a significant portion of revenue turns into profit before operating costs. Cost management. A higher gross margin ratio indicates effective control over costs of goods sold, improving profitability. Competitive advantage. Maintaining a strong gross margin helps FedEx reinvest in business operations, technology, and growth initiatives while staying competitive in the transportation industry. So in conclusion, FedEx's consistent gross margin ratios reflects its solid profitability and strong cost management, which helps position itself as an efficient operator in this competitive industry. FedEx's operating margin ratios highlight its ability to manage operating costs and generate profit from the core business activities compared to industry average. Looking at our margin ratios, our operating margin ratios, FedEx does fall below the industry average for 2024. This implies its efficiency in operations, so FedEx operating margin shows how well the company controls costs, including selling, general, and administrative expenses and other operating costs. It's also a profitability indicator, so a higher operating margin means that FedEx is converting a significant portion of revenue into its profit after covering all of its other expenses. This also includes financial health, so strong operating margins indicate FedEx's ability to weather cost fluctuations and maintain a stable profit from operations and operating expenses. So in conclusion, FedEx's solid operating margin ratio demonstrates its effectiveness at cost management and operational efficiency. This reinforces its competitive position in this sector. FedEx's profit margin ratios shows its ability to generate net profit after all expenses, which includes its taxes and interest compared to the industry averages. These implications include a strong bottom line, so a higher profit margin indicates that FedEx is very effective at controlling total costs and generating profit from its revenues. This includes cost control and pricing power, so FedEx's ability to maintain a healthy profit margin demonstrates good cost control and pricing strategies. Financial stability. FedEx's ability to maintain a healthy profit margin and consistent profit margin signals that FedEx can sustain profitability even during market fluctuations or increased operational costs. In conclusion, FedEx's solid profit margin reflects its strong cost management and profitability, which ensures long-term financial stability and shareholder value. FedEx's return on equity ratios are higher than the industry average in 2024. This reflects the company's ability to generate profit from its shareholders' equity compared to the industry averages. These implications include profitability for investors, so a higher ROE indicates that FedEx is using its shareholders' equity efficiently to generate profits, delivering strong returns to investors. Also, effective capital utilization. Strong ROE shows that FedEx is making good use of its retained earnings and reinvested profits to drive growth and profitability. Investor confidence. Consistently high ROE is a positive indicator for shareholders, which signals strong management performance and financial health. So FedEx's solid ROE demonstrates its effective use of equity capital to generate its profit, which ends up reinforcing shareholder confidence and supports the long-term growth potential. FedEx's return on assets ratios reflect its efficiency in generating profit from its total assets compared to the industry average. These implications include efficient asset utilization, so a higher ROA indicates that FedEx is effectively using its assets to generate profits, showcasing its operational efficiency. Asset management. A strong ROA also reflects FedEx's ability to convert investments into assets, so vehicles, equipment, etc., into earnings. Profitability indicator as well, so consistently high ROA signals that FedEx can generate a solid return on the resources it controls, even with its asset-heavy business model. So in conclusion, FedEx's strong ROA highlights its effective asset management and profitability, which positions it as a leader in leveraging its assets for a sustained earnings per share from 2021 to 2024 reflects its ability to generate profit per outstanding share, demonstrating its profitability growth over the period. These implications include a strong profitability, so a consistent EPS growth highlights FedEx's strong financial performance and its ability to create value for shareholders. Investor appeal. Rising EPS makes FedEx attractive to investors looking for companies with strong earnings potential. Efficient operations. FedEx's EPS reflects its ability to manage costs effectively while growing its bottom line, making it competitive within the sector. So FedEx's solid EPS positions itself as a financially robust company in the transportation industry. All of this culminates to offering long-term value for investors. So FedEx's PE ratios for 2021 to 2024 are consistently lower than the industry average of 24.51, indicating it has potential undervaluation relative to its peers and other firms in the sector. These implications include undervalued stock, so a lower PE ratio suggests that FedEx's stock may be undervalued, which provides potential growth opportunities for investors. Market sentiment. Investors may be pricing FedEx more conservatively compared to the broader transportation sector, possibly reflecting lower earnings, expectations, or caution. Attractive investors. The lower PE could indicate FedEx is an attractive buy for investors seeking value stocks. In conclusion, FedEx's PE ratio reflects market conservatism, suggesting that potential undervaluation opportunities for long-term investors. FedEx's market-to-book ratios in the past 4 years are consistently lower than the industry average of 3.49. This also kind of points to potential undervaluation, just as the last slide mentioned. The implications include underpriced assets, so a lower ratio suggests that the market values FedEx's assets more conservatively than its competitors. These investment opportunities could indicate FedEx is an attractive investment for those looking for stocks trading below their book value. This also includes stable asset management. So despite lower valuations, FedEx's strong asset management keeps its book value competitive. So FedEx's lower market-to-book ratio highlights a possible opportunity for investors seeking value in underappreciated assets. This is just my design statement and my sources. Thanks for following along, everybody.